Most Americans never learn how debt controls their daily lives. Before the U.S. became a global superpower, money worked differently. Banks created systems no one fully understood, quietly shaping futures. This one decision shaped the life of every American today. Debt isn't accidental, it's designed to keep people trapped. The story begins in post-war America, with booming optimism. Families bought homes they couldn't really afford yet proudly owned. Credit cards emerged as symbols of freedom and modern life. Early banks pushed borrowing as patriotic and necessary for growth. Americans believed debt was temporary, a tool, not a trap. The government encouraged spending to fuel economic recovery after World War II. Banks offered low interest rates to hook millions of Americans. Advertising normalized debt, making it feel like personal success. Loans became the invisible tether between Americans and their future. Even small communities felt pressure to participate in national debt culture. In the 1950s, the first mass-market credit cards appeared. Families learned to rely on borrowed money for everyday needs. Suddenly, monthly bills dictated life choices more than income. Student loans started to emerge quietly, promising education dreams. Car financing became a cultural expectation, not a privilege. Every new debt product pushed Americans further into long-term obligation. Banks grew more powerful than local communities or small businesses. Interest rates became invisible chains, shaping entire generations' decisions. People rarely questioned the system because prosperity seemed endless. Debt became normalized as part of the American dream. It looked voluntary, but subtle forces nudged citizens constantly. The Federal Reserve's influence quietly shaped borrowing and spending patterns. Government policy indirectly reinforced credit dependence over cash savings. By the 1960s, Americans were living paycheck to paycheck more than ever. The roots of the system reach back to early U.S. history. Colonial Americans borrowed heavily from British lenders to survive. The 1792 Coinage Act set early standards for U.S. money. Banks began consolidating power while ordinary citizens stayed uninformed. The California gold rush fueled speculative borrowing and risky loans. Railroads borrowed billions, leaving citizens tied to financial outcomes. Early crises taught Americans fear, not financial literacy. The Great Depression exposed the fragility of credit systems. Bank failures wiped out savings for millions of Americans. New Deal policies restructured banking but didn't eliminate debt cycles. The 1930s created the foundation for modern credit markets. In 1971, Nixon ended the gold standard, changing money forever. The Federal Reserve gained unprecedented control over American purchasing power. Dollar dominance gave the U.S. leverage, but citizens paid invisible costs. Credit cards exploded in the 1970s, making borrowing instant and easy. Middle-class families felt prosperity, but increasingly relied on invisible loans. Banks lobbied to remove regulations, pushing more Americans into debt. Inflation rose, but borrowing kept spending afloat for decades. Student loans grew into a multi-trillion-dollar American crisis. Every economic boom seemed tied to expanding household debt. Wall Street profited while ordinary Americans struggled to keep up. Interest compounded, and Americans learned to pay for decades. Debt became a quiet, constant stress in American homes. Even retirement planning now depended on managing credit wisely. Credit dependency shaped consumer habits without most Americans noticing. By the 1980s, credit was ingrained in every household budget. Home equity loans masked growing reliance on borrowed money. Bank marketing perfected psychological nudges to keep citizens spending. The 2008 financial crisis revealed the dangers of systemic debt. Millions lost homes, jobs, and faith in the system. Yet banks survived, and debt cycles restarted almost immediately. The U.S. government often bailed institutions, not families, out. The average American household today owes tens of thousands in credit. Interest payments often outpace actual wealth growth from middle-class families. Renters face skyrocketing costs, further forcing reliance on credit. Inflation eats wages, but debt keeps families afloat temporarily. Federal Reserve policies indirectly encourage Americans to borrow more continuously. Banks strategically profit from recurring loans and late fees. Consumer culture reinforces immediate gratification over long-term financial health. Credit keeps Americans spending, which fuels both personal and national growth. Yet many feel trapped in cycles they can't escape. The system rewards banks, investors, and the wealthy over regular citizens. Middle-class Americans bear the brunt of invisible financial engineering. Even small emergencies can push families deeper into borrowed money. Student loans prevent young adults from buying homes or saving. Homebuyers accept higher mortgage rates as just part of life. Credit cards make everyday purchases deceptively expensive over time. Auto loans chain Americans to monthly payments for years. Retirees often rely on borrowed money to supplement fixed income. Debt becomes a generational inheritance, silently passed to children. Many Americans feel financial anxiety, even during prosperity. Banking culture thrives on stress, dependence, and recurring borrowing. Student debt affects life choices, family planning, and career paths. Households cut essentials to meet minimum monthly payments. The illusion of freedom hides subtle, systemic control by banks. Credit traps seem invisible until late financial crises strike. Every swipe, every loan, quietly extends the cycle of dependency. The lesson: understanding debt is more than math, it's power dynamics. Financial literacy can break the chains, but few are taught early. Americans must recognize how systems shape choices over lifetimes. Debt isn't a failure, it's designed, marketed, and enforced. Families must prioritize knowledge, savings, and mindful spending habits. Financial independence starts by questioning normalized borrowing culture. Small decisions now define decades of American lives silently. The final message: true freedom begins when Americans control their own money.